Hello, everyone. This is Toni Vanschoyck, the wealth rescue guru, coming to you. This is going to be our very first session that we are sharing this incredible platform with you and revamping on our podcast. I'm super excited to have you here as a part of this kickoff call tonight. And I actually have been partnering with Joe over the last year. I met him actually through my book publisher. He's quite the connector. Hands up to Mike Fallett because I've met a lot of really cool people through him. But let me give you guys a little bit of background because we're going to go a little bit more in depth. And I just want to be super transparent on this call is because I have been in business as an entrepreneur for the past 20 years. From all the way from, I started in the restaurant industry running very big restaurant chains. And then I started having children and I said, oh, I want to do my own thing. And I had my own brick and mortars for a very long time and then got bit by the network marketing industry. Like it was a really good bite though. And I've still been in that 30 years to the date. And through this process of my journey, now, over the last 10 years, we have 7 streams of revenue income, and 3 of those 7 are residual. And residual is a big deal for me because this is something that you invest, you build, and then it keeps paying you month after month, year after year, generation after generation. But what I wanted to share with you is the platforms to really build generational wealth. And one of those platforms, and also two, a key platform that you can build generational wealth and also a multi-million-dollar figure income is through real estate. I had poo-pooed real estate for years and years because I didn't want to get involved with it. It was too busy. People were on your time for appointments for either residential or commercial. But then I found these platforms that were truly simple and that you could just take, your investment money, you could invest it and it would work for you and it was duplicable. And it's just like a super simple system because what has happened is that there's been people that have set up these platforms in all sorts of real estate investing. But the one thing that I love about self-storage is the simplicity of it, the ease of it, and the potential ROI. So I invited Joe. I call him the king of self-storage investment. And I was just like, we were talking today when we were on social media, and I'm like, oh man, this is a sexy platform because I love it because of the simplicity. But what we've seen is that when we first started our investments last summer, is that we started getting residuals every single month. I didn't have the capacity to wrap my head around that. And now, our checks came today, we posted them, and I call it mailbox money. But what happens is that you're getting paid on the front end and the back end of it. So without further ado, I want to introduce Joe. He's been in construction ever since he was a wee. And then he has been in the real estate arena since 2007. So a hell of a lot longer than me. He's very, very wise and educated in this particular type of setting and scenario. But I'm really excited because this is one of the things that I can share with you guys on how you can build this for not just your retirement, but for you and your family and your grandchildren and your dogs, if you want, whatever the case is, that this is your platform. So without further ado, Joe, talk to my friends here that are listening to you. Talk to them about how incredible and the shit that you got going on, my friend.
Yeah, I would love to. Thank you for the intro. And folks, definitely, I would love to encourage you to make this interactive, make it a Q&A. I don't want to sit here and, open up a PowerPoint presentation and bore the crap out of you. I love to really answer your questions, and no questions are stupid. This is something that, again, it's a very simple business and, but it doesn't mean that, your questions, don't deserve to be answered. And so I'd love to kind of do a deep dive into what we do and help you guys understand it a little bit better because, it's a new industry for some of you. So I'm happy to kind of answer whatever you might want to know about. But just to give you a kind of a quick background, I mean, Toni did a great job introducing me. Joe Evangelisti, I've been in construction my whole life. My dad, who I just got done eating dinner with, my in-laws, my dad, my family live within a block of my house. So we have family dinner like 5 nights a week. Grew up as a son of a construction general contractor guy. And my dad and my parents got divorced when I was like 2. So my dad was one of those blue collar GC guys working 8 days a week. And I was with him nights and weekends. And so, always on the job site, always out there, picking up drywall scraps and sweeping floors and cleaning job sites. I just learned to love construction my whole life, just really enjoyed it. If you asked me when I was 10 years old what I wanted to be, I wanted to take over my dad's general contracting business. And lucky enough, I got to, outside of high school, go into the military and actually become a U.S. Navy CB, which is the construction battalions, the builders of the Navy. For some of you who watched the live earlier, you're going to get a repeat of this, but I promise I'll kind of summarize it real quick for those of you who didn't see it. And then right after that, went into flipping houses. In 2007, got into the business and, started flipping houses right away. Got smacked in the face, right? 2008 came around. I think we were on our 3rd or 4th flip when the market really just fell out from underneath of us. And, it was a really lucky time for us because, I look at it as, a lot of times adversity creates the seeds of opportunity, right? Like I think things happen to us for a reason. And I believe that these problems are put in front of us to really not only just challenge us, but teach us, ways to do things differently. And so, I was flipping houses and, I learned I had to become a salesperson. I had to get my broker's license. I had to get into real estate sales and, pivot and course correct until I could figure out how to start to take advantage of that market and that market cycle. And that was wonderful. It really taught me to build a team, to build systems, to build processes around it. And then we got to scaling up and doing, to the point where we almost did 100 houses a year, fix and flip, literally buying houses, fixing them up, putting them on the market and selling them. And as you can imagine, that was a nightmare, right? Just a really, really tough, transactional, difficult business, massive cash flow, 50 employees roughly, massive payroll. It was a bitch. And, at the time we were making lots of money, but I was massively stressed. I wasn't being a great father. I was being a terrible husband. I was working 150 hours a week. Wasn't enjoying my life, but I was making lots of money. And, my partner and I about 5 years ago really had a hard reset. And we said to ourselves, like, how do we make the money we're making today, but learn to take back our lifestyle and create real wealth, right? Because we were in the real estate game. And one of the things I want to impart on you folks tonight, if you're not already in the real estate game, it was like I was in the real estate game making cash, but I wasn't creating wealth, right? Because I wasn't keeping enough of the assets. We were flipping. I kept a few of them. And I did create a little bit of wealth off the ones that we kept. When it all dust settled, I had kept about 125 rental properties. But the reality of it was I had probably bought and sold $150 million worth of real estate in 12 years. And I ended up keeping about $20 million of it. So it really wasn't, as lucrative long-term wealth building. Now we're buying and selling $20 to $30 million individual assets, right? It's a whole different ballgame. And so we wanted to transition into commercial assets that we knew not only could we build wealth, but our investors could build along with us. Our team could build along with us. The transactional game, it's money in, money out. It's buy, sell, trade. And, the cash is great, like I said, but you're not taking advantage of the real benefits of real estate, which are the tax advantages. You get the tax advantages from holding real estate. You get tax advantages from appreciation being created. You get tax advantages from, you're getting your cost segregations and, certain things which we'll get into where you can actually get those long-term buy and hold tax advantages. Again, you're not getting that in a single family flip. In fact, it's worse, right? Because you're getting what's called short-term capital gains. You're getting almost double taxed when you buy and sell something really quick. So it's like a pump of dopamine, right? You get a big pump of cash, but at the end of the year, the federal government's like, we're going to take a big chunk of that because you made money too quick. So in the commercial game, it's much different. We can buy an asset, we can build an asset, we can develop an asset, which is what we do now, and we can hold it for the long term, and our tenants can pay our mortgage. Our tenants can keep that facility running. And the one thing that Toni said earlier, which I love, is that it's funny. She says the opposite. She says it's a sexy business. I actually say it's not a sexy business, but the money is really sexy, right? Because face it, we're building metal boxes with concrete floors, guys. Like when I was flipping houses, that was actually a sexy business. I could run around with Facebook Live and show these really cool kitchens and bathrooms and houses we were building. Now it's like I go through a 100,000 square foot facility, and it's like I got nothing to show. It's metal boxes and roll up garage doors and asphalt driveways. And I don't particularly think it's sexy, but the income is sexy. The valuation is sexy. The money generated is sexy. Certainly the interest checks that get sent out to our investors every month is sexy. And the long-term wealth creation is sexy. So we can get into the details of what the investment looks like and how we build it. But bottom line is now we're creating, again, what I call legacy wealth building. The reality of it is we can partner along with our investors like Toni. We can create these beautiful assets. And these are low maintenance assets. They're not multifamily apartments where we have to go build, 20, 30, 50 kitchens, bathrooms, toilets, countertops, tile, paint, trim, carpet. A lot of these things are depreciating assets because they need constant maintenance and constant updates. Every time a tenant moves in and out, they're ruining things and you have to go back and fix them. I was making this joke the other day during one of our presentations that, when a tenant moves out, what are they going to do to a unit? The worst they could do is leave their stuff there, and we got to take it out, throw it in the trash, and sweep the unit clean. It's ready to go the same day. I can't tell you how many nightmare tenants I've had throughout the years in residential housing where it takes us a month to 2 months to renovate that property to get it back on the market, and we lose 2, 3, 4 months of rent to get that what they call make ready, right? Get the apartment back online to rent. And you're losing a quarter of the year. The beautiful thing about storage is these units or these developments, they have 700, 800 tenants, so again, the turnaround is much quicker and the occupancy is much higher, and altogether the income is much more stable. So again, I don't want to get bored. I don't want to bore you guys. I want to kind of give you a little bit of background and input into like what the investment looks like and how to get involved in these. Long and short of it, we develop Class A self-storage. And I'll give you guys a quick look. I told you I wouldn't bore you with PowerPoint. I just want to give you a quick look at what that... Oh, you know what, Toni? Can you make me a...
I got it. Yeah, I have to make you an admin. Hold on 1 second. Okay, there you go.
All right, let me see if I can screen share my...
There you go.
Chrome here. And I got to find the tab that I just opened up a minute ago. Where was it? Okay. So to give you an idea, this is a project in Pearland, Texas. This is a suburb of Houston. And this is a rendering, obviously, but this is a project that's going to break ground here in the next month or two. This is a... oh, somebody's trying to come in the room. I'll let them in. This is a project. It's about 100,000 square foot self-storage facility. It's about to come out of the ground. This is kind of a good example of what our projects look like. Again, some people think it's a sexy looking project. Some people drive by and think, it's pretty vanilla, commercial building. But essentially, this is what, a $20, $25 million asset looks like
having chemo
when it's all said and done.
Yeah,
right. But just to kind of fast forward to give you a couple highlights about the industry itself. Right now, this is a $40 billion a year industry. Right now, the average households, and this number has gone way up. Actually, this data is about 9 months old. But the average is about 10 to 15% of Americans have their stuff in self-storage. Now that got bumped quite a bit during COVID because obviously COVID shook a lot of things up. But what we're finding is that COVID got really sticky. In other words, people put their stuff in storage; they're not taking it out, right? Because human beings are creatures of habit. So they really kind of stayed with it. And so a lot of these newer environments, we're really changing as Americans. A lot of the work from home environments, right? A lot of offices have downsized. A lot of transition has happened. And, I said earlier that the adversity created opportunity. Well, what's happened is a lot of people started to work from home. A lot of offices have started to shift their cultures. And they decided, hey, you know what? We're actually pretty productive with this stay-at-home thing. We might we might leave it that way. And what's happened is it started to stick, right? nationwide, this is a really interesting statistic. 92 to 94% is a nationwide average occupancy rate. That's pretty crazy. If you're familiar with real estate, you know, for your like, for example, your apartment buildings, again, depending on unit mix and how things are situated, you could be talking about, for example, 80 to 85% on an average apartment building. 92 to 94 is super, super high. And a lot of times it's only that low because of your unit mix, right? You might have too many 10 by 10s, or you might have too many big garages, and that makes up for your loss of unit mix. One thing I say to folks is, you know, people say, man, these self-storage are going up everywhere. Is there really a big demand for them? Yes, in certain cities, they're a little bit oversaturated. In most cases, I tell people, like, go around, Google self-storage in your area, and call around and ask for a 10 by 10 climate-controlled unit. You're going to find out that 4 out of 5 are full. You can't get a 10 by 10 climate-controlled unit. They're full. And so the demand is outpacing the supply in most major markets around the country. There's about 50,000 or 49,000 self-storage facilities. We cannot keep up with the demand for those facilities around the country. So jump right into what does the numbers look like? We essentially pay our investors 4 different ways, and then I'm going to kind of open it up to Q&A, because I know you guys are going to have a lot of questions, and then I'll kind of go back through the deck and answer some of those for you. Number one, when you invest with us, the first things first, those checks that you see Toni posting on her wall, we pay what's called a 10% monthly preferred return. So basing it on a 100K investment, you're going to get basically a check for like $833 a month, right? So if you take $10,000 a year, you divide it by 12 months, it comes out to $833. So you're going to get a monthly return on your $100,000 investment. Now, most people immediately go to that and they say, well, that's amazing. I'm making 10% return. That's great. You know, and it's fixed, and it's, you know, it's backed by a piece of real estate. You know, I'm a percentage owner in a piece of real estate, and I'm getting a return. I always tell folks, don't focus on that. That's great. Everybody's getting a return. That's wonderful. But the reality of it is you have equity. And I'll explain that in a second. We also get a piece of refinance, future refinances. So at some point with real estate, with commercial real estate especially, what happens is it's not like your single family residence. You know, a lot of us, our homes will appreciate over time. Let's say you bought your home for, you know, $400,000, and 5 years later it's worth $700,000, and you refinance to $500,000. You take $100,000 cash out, right? That's a refinance. That cash out you take is tax free because it's considered debt, so you don't pay taxes on that. Same thing happens in commercial real estate. The difference is your tenants are paying down your principal. You know, we're paying our principal in our house, but in commercial real estate, your tenants are actually paying down your principal. But also the appreciation is driving up the value of the asset over time. So there's going to be, every few years, there's going to be a reprice in our mortgage, and there's most likely going to be a gap created between the value of our mortgage and the value of the asset. So every few years, we're going to recycle and refinance, and you're going to want to take out some cash difference. Every time we take out that cash difference in the asset, you as an investor will get your percentage of that refinance in a check in the mail, and that will be tax-free because, again, it's debt and there's no tax paid on it. Likewise, this monthly return, we actually code on your tax return as return of capital. So you're not paying taxes on the interest that's being returned to you each month. Now, this is really where it gets good, okay? After your capital is returned, now it's a 3-year loan. So within 3 years, or on or before 3 years, you're going to receive your $100,000 back. At some point, we're going to refinance the debt, because we're going to go out to the bank and we're going to get construction loans. We're going to build this asset. We're going to refinance, or we're going to sell the asset. When we do, you get your capital returned. At that point, you're still left with approximately $86,000 in equity in that property. Now that's day one. So this is where I call it, like, you know, basically you have like, you're playing with house money, right? So all of your money has been returned at this point, plus, go back. Plus you've made, let's say 3 years of $10,000 payments. So you have $30,000. Now that's shown over here. And you've made, let's say, a refinance proceeds of $17,000. Let's say you've made $47,000 tax-free up to this point on your $100,000 investment. Year 3, you're going to get back a check for $100,000, plus you've made $47,000. You're still remaining with $86,000 in equity. Okay, that means you still have a balance of equity day 1 of $86,000. Now, let's say we go on and we keep this property for 5 years, for 10 years. Understand, a lot of syndicators or investors who are doing syndications like this, once that principal is returned, they'll kind of kick you out of equity, right? They'll remove you as an LP or an equity partner, because once your capital is returned, they look at it and say, well, you're not a capital partner anymore, so bye-bye, right? At Legacy, we've decided to treat it like a legacy investment. We've decided that as a legacy investor, you deserve to ride along in perpetuity as an equity investor. So therefore, you're going to keep your equity as long as we keep the property, right? So if we keep the property for 5 years or 10 years, and by the way, that's our goal. I always tell folks, we're agnostic about the outcome, right? If somebody comes along and gives us a great offer, then we're going to sell. And at that point, you're going to realize your equity investment at that point, right? Whether it's 3 years or 5 years or 10 years, at some point, you're going to get this money back, okay? But until that happens, you have that equity in that property. This number is going to do nothing but go up, because over the course of time, we're going to continue to create equity. Also, you're going to get your percentage of cash flow. These properties produce somewhere in the range of $300,000 to $400,000 a year in positive, what's called net operating income. Let's say you had a 1% investment or a $100,000 investment. By the way, for every $100,000 you invest, you get 1% equity in one of these deals. A $100,000 investment like this would produce about $3,000 a year in what we call mailbox money. So every quarter, after the project's stabilized and tenants are in place and you've gotten all your money back, you're still going to receive about $3,200 a year sent to your inbox every quarter. So there's 4 ways that basically we get returns. Now, the interesting thing is down here, you'll see there's a approximate summary of, like, let's say a 15.8% cash on cash return. This does not take into account these 2 things, okay? So in other words, this is only while your money is at play are you making about a 15.8% return. It does not take into account your equity that you are creating, which, as you can tell, is worth a heck of a lot more than the return. Does that make sense to a lot of you guys? I hope it does. I know it gets a little bit confusing. We try to make it as simple as possible. But again, whatever I want to draw your focus to is a lot of people look at this. This is great. You know, you're going to get mailbox money every month. You can use it to pay your car payment. You can use it to put towards your mortgage. You can use it to play with. You can use it to do whatever you want. But the reality of it is, to me, this is the legacy piece. This is where wealth is made. You're going to own a piece of a $20, $30 million asset. To me, this is the benefit, because, folks, my goal is that if you give us 100K, 3 years later, we return that 100K, you still have this at play. What are you going to do? You're going to turn around and say, okay, Joe, what's next? Give us 100K, do another deal. 10 years from now, you could own, potentially, hypothetically, 3 pieces of equity in 3 separate deals with 1 investment, right? That's the goal. Roll it into a different deal, have 3 separate pieces of equity with the same investment. And I hope that makes sense, right? So, Toni, did that do a good job of explaining that?
Yeah, that was great. That was great.
Right.
Because the first time I heard it, I was like, oh shit, I'm not sure about this. I
Yeah.
want to go back to what you said about the equity that you're receiving every month,
Yep.
because what I did is I created a completely separate account to put all of the funds in every single month that I get from my investment. So now we're up to, I believe it's we're up to $25,000 that we've gotten back from you, from our original investments. But we're going to take that money, and once we get enough for another share, that's what we're doing with the.
I love that. So you're going to
Yeah.
compound your own interest.
Yes, exactly.
Yeah,
But
that's great.
like what you said before is that, again, we have our other income streams, but I'm taking this specific one that we have invested with you, and we're, putting that aside because we're going to reinvest all of that profit, and yet again have more shares and more equity in more buildings, because that's a big deal for us, right? We want to have, my end goal by 2025, I want to have, at least 25 units that we've invested in, because it's a smart investment.
Yep.
I'm just using that as an example. So, just, what we're doing with our profit, I'm not spending it. I'm not using it as play money. Right now, I think, especially with what's going on, we all need to double down, and we all need to be investing in our future.
Yeah, it's smart. It's smart. And by the way, folks, you can do this with cash. You can do this with self-directed IRA. You can do this with retirement funds. If you self-direct them, you can roll them over and self-direct them. There's a myriad of different ways you can play around and do this. I actually have my wife's self-directed IRA in an LP share. I have my own cash and LP shares. So there's a lot of different ways you can play around with creating, angles to invest in these things. So, if you want to get creative and you want to talk about that, we obviously can. But again, I like creating little pockets where, kind of what you're doing, Toni, is I create the pockets, and then the money goes back to a little rabbit holes where I can't find it, so it automates that way. Again, I love those type of things because I tend to do it and then I forget about it. Right. So that's my favorite type of investment. But I'll open up the questions from you guys. If you want to talk about it, questions, thoughts, questions about particular deals. And then I kind of got a little bit of something fun I can share with you guys at the end here too. See if there's anybody in the chat. When economy is down, it's the best time to soar. This is cool building. I'm in Texas. Awesome. Outside of Houston. Oh, Toni said that's one of mine. Oh, Toni, you're in Pearland? I forgot about that. Insane occupancy. Hoorah. Navy. All right. So Tatiana, great question. Is 100K the minimum investment? Yes, it is. The 100K is the minimum investment. However, and you guys can't repeat this to anybody because you're all Toni's family. I told her I would do something special for you guys tonight. And I swear to you, I've never done this before, but I told her I would do something special for you guys. So number one, before I even say this, you have to be an accredited investor. Okay. I think most of you are accredited investors. If you're not, you can go Google it. It's pretty self-explanatory. But accredited investors is pretty simplistic. You have to have 200K in income as a single person, or 300K as a married couple. Or $1 million in net worth, and there's a bunch of different things that qualify you. One thing that's interesting, if anybody here has a pension, I always use one of my buddies. One of my buddies that just retired from the military as a master chief is an accredited investor, and people go, "Well, how's that possible?" Well, he retired with 100% disability, and he's 42 years old. And you say, "How's he accredited?" Well, he made some good investments while he was in. But we can actually roll up his entire projected retirement earnings over the next 40 years and calculate those out and combine them to accreditate him. In other words, there's many ways you can qualify to be accredited. So don't let that scare you. If you think you're even close, or you think there's a way to make it happen, call me. We can talk about it. Essentially you have to be self-accredited. I don't have to prove it or, verify you or anything like that. However, what I was going to say is, for friends and family of Toni, we're going to, particularly for this Pearland deal, we're going to reduce the minimum to half shares, to 50K investment. Two caveats to that. I'm going to be away all next week. Okay. So I'm in Maine with a bunch of crazy guys going down a Category 5 river. Don't ask me why I'm doing this, but I think it's going to be a bunch of fun. And so I won't be around next week to talk about this. I'm going to open up my calendar Friday and Saturday. I just opened up my Calendly link. In fact, I'll post it in here for you guys. Let me find it. I opened my calendar on Saturday to take some calls if any of you guys have any questions. And I'll post a link in here. But Friday and Saturday, I have some openings to talk through this. If you guys want to hop on a call and talk to me over the weekend, I'll drop the minimum investment to 50. Hop on a call, talk to me over Friday, Saturday. If you guys invest next week, I mean, if we talk this weekend and you guys are liquid and you're ready to go for action takers and friends of Tony's, we go through everything and you're cool with it, and I can set you up next week with Stacy and Brian while I'm out. And if you guys invest next week while I'm gone, or even this weekend or whatever, if you do it in the next week, we'll do 50K minimum shares. Now, it will be this deal in Pearland. We have a couple shares left in this deal, and this deal is actually getting ready to come out of the ground here in the next couple months. So awesome deal, awesome location. It's a great deal. I've invested in it myself. Tony's invested in it herself, which is actually ironic and cool because I forgot she was in it. So I didn't even plan that. But it is a great deal. And again, we'll do half shares. So whether you do 50 grand, 150 grand, 450 grand, we'll do half shares for you guys to get involved in that project. And would love to, really, I do it as a friends and family to kind of intro you to the show, because frankly, it is simple. It is duplicable. And I think once you're invested with us and you see, the culture and the team and the automated process and all that kind of thing, you'll tell your friends about it, and you'll want to do more with us. And that's why we're on this call, right?
The other thing I want you guys to remember too, is that when you do this versus a 401k or stocks and that type of thing, is that it is not a tax advantage. The one thing that I will tell you, you think that you're getting a bigger percentage on your 401k than it usually is. And if your employer says they're matching, let's say 6%, it's really only 2%. So you have to look at what's going to work for you and what is going to be, cognizant for you in the long run. The one thing that I will tell you is that when you do this, because the government can't touch your money, the stock market, if it crashes or if it goes down, you're not going to lose that. You're not going to lose that money right there and then. Now, is everything guaranteed? Of course not. No. Yeah. The reason why I am sharing this with you guys is because I am a proponent to change the way that people think about creating wealth. There's so much misconception out there. And I am going to go down this rabbit hole because I know most of you on this call is that they want you to think that 401k and stocks are a safe investment, and they're the most volatile because the government and the big 3 companies that own most of them can completely affect on what you invest. This is completely different. It's all private. And not only that, you guys, being in the groups and the rooms that I have been in for the last year and a half, everything that has been done and everything that I have invested in has been in private equity, period. And that's where the power of this is. It is in the power of the private, not the public. So we'll do more education as that goes. I want to keep this solely focused on what Joe can do for you and for your future outlook for the next 3 years. The last thing I'm going to tell you.
You just reminded me of something when you said that, and I should have brought it up earlier. Sure. One more tax advantage, guys. So real estate, commercial, we do development. During the build phase, tax advantage wise, cost segregation, we can't depreciate anything when you're building something, right? However, once the doors open, this is where it gets really special. So we did a cost segregation and a cost segregation, by the way, I don't want to get really like super technical, but you can accelerate depreciation. Now, so what that means is, when you take a piece of real estate in commercial world, what you can do is you can say over the course of 27 years, I'm going to take the value of the asset and I can divide it by 27. And every year for 27 years, I can take that value and I can write it off my taxes. Okay. Just keep it simple. In an accelerated depreciation, I can accelerate that down to 5 years. Okay. So let's say a property is worth $10 million. I can take $270,000 for 27 years. Does that make sense to a lot of you, right? In an accelerated depreciation, I can take $2 million a year for 5 years. Okay. So once the doors open to these projects, we have a project in New Jersey. We did this year. We had a site that just opened. For every investor that had $100,000 invested, they got a write-off this year of $37,000. Immediate write-off. $37,000. Now their money's still out, right? As soon as that money comes back next year, they're going to get another $37,000. They'll have their money back in their pocket next year, and they'll still get $37,000. Now, I don't know if we're going to keep that asset, right? If we do, they're going to get $37,000 for the next 5 years, even when their money comes back. So imagine that. Imagine getting your 100K back. You're still making, now they've made 10% for 3 years. They're going to turn around. They're going to get the refinance when it happens. They're going to get a $37,000 write-off this year, $37,000 write-off next year, right? Going to potentially have a refinance event in the next 24 months where they're going to get a tax-free check for somewhere in the ballpark of $20,000 to $30,000. And they're going to start getting cash flow in the next 24 months. And that's all in a 100K investment. So again, this isn't magic. It's commercial real estate. I mean, I don't claim to be a magician. I'm a developer, but this stuff is real, guys. I mean, it works. It happens. And I forgot about that entire benefit. So you look at that. I'm showing you guys returns. Returns is only part of it. It's the tax benefits that are really truly part of that wealth building process as well.
100%. So here's the great thing. So when I first started investing with Joe, he sent me the contract, and the contract is quite lengthy. And you guys, I don't do anything without my business attorney. She's been my right and left hand for 8 years. But I sent it to her, and she was looking over everything. She was doing research on legacy. She was doing research on the properties that we were looking to invest in. And she calls me, she's so funny. She calls me on the phone and she goes, "Toni, you're fucking crazy if you don't invest with this." That's exactly what Becca said. And she's not like that at all. She's very discerning. She's very detail oriented. And I called Joe the next day and I said, "All right, let's go." Nice. And so it's just been a great working relationship for this past year. And I want to be able to share this with people that really want to make a difference in their future. Love and it. Also, I'm not giving my money to the fucking government. Just not.
Well, that's the whole goal. We don't want to give any money to the government. So.
Right. Right. So you guys, do you have any other questions at all? You can feel free to unmute. If you have questions, hey, Joe, will you, I know you dropped your Calendly link, but where's the easiest way that they can find you, either on social media, or if they have a quick message to text you or something like that? Can you drop that in the chat?
I'll even drop, I don't mind dropping my, hold on a second. I'll drop my cell phone here. You guys can text me too.
Yeah.
The Calendly link is obviously, if you guys want to set up a call, I'm happy to. You guys can text me. My name is pretty unique, so you can copy and paste my name in Facebook or Instagram. You can feel free to message me. Happy to chat. I'm available. And I tell everybody too, like, it's not that often that you can get the CEO of these, syndication companies to just chat with you on the cell phone. I mean, me and Toni chat quite a bit. I'm here to talk to you guys. I want to be, open about the investments, good and bad. It's construction, stuff happens, there's delays, there's issues. I want to be available to my investors to talk about when stuff goes right and when stuff goes bad. I think the communication both ways is like one of the biggest things and the biggest factors in this business. That's the reason why I want to be open. I want to be available.
Awesome. So you guys, thanks for a little bit of your time tonight. I can't wait to see, how this is going to happen. Actually, so Joe is going to be down. I'm going to do a wealth seminar on September 23rd as well. I'm going to get this rolling. I'm going to get this up on our platform. This technically, and I forgot to mention this in the beginning, I'll have to have Kylie add this. It's also going to be broadcasted as our first rebranding podcast for Wealth Rescue, because this is what it's all about. It's all about helping people be financially independent and be free of, just be free of any thing that's trying to govern us or tell us what to do, or where we have to send our money in on without provocation or whatever. But the great thing is that this is one of the very first things of, and again, there's only a handful of things as far as that goes. This is one of probably 3 or 4 that you can really sink your teeth into and really make a difference in where your money is going to work for you. And that's what I want. I want your money to work for you. Mm-hmm. Awesome.
Awesome.
All right, Joe, thank you so much, my friend. You guys, thank you so much for your time tonight. I appreciate you all. Mwah. Love you. Good night.
Thanks, guys.